The biggest breakthrough in my trading didn't come from learning a magic strategy or some secret algo source. The biggest breakthrough in my trading came from identifying key levels, right? So before I used to chase trades every single day, catching 13, 14 trades a day. Now it's 1 or 2 clean setups of 1 or 2 key levels.
So here we have the S&P 500 chart on the 15-minute time frame. And what I'm going to be doing is I'm going to be breaking down how I go through my entire approach from higher time frame to lower time frame, but specifically on finding those key levels. So on the 4-hour time frame, S&P 500, right? The way that I like to look at this is I like to split things up into 4 major chunks, right? So I look at my market structure. So very quickly, I made previous videos on this, but my market structure is a high, a low, and from here, the way that I use structure is I'm very mechanical with it. I just want to see where was the last low that broke the previous high. So in this case, we have a structural high resting over here. Now we have a structural low. And then from here, we have more, I guess, detailed structure, right? So again, we're just looking at basic 4-hour market structure. So we have a break here. We have a break here. We have, the way I would do is we have a break here. We then have a break here. And then we break structure over here. So this is one of the most simple concepts, and I don't want to spend too much time on it. But a lot of traders, I think, need to understand and grasp the basics. And I always start off with basic market structure, just marking out where the breaks actually are occurring. So we had a break of this low down here, and then this low was responsible for breaking the previous high. So from a structural perspective, this is how I'm looking at the 4-hour. Now on the 15, I do a similar sort of thing, right? I do a very, very similar sort of thing. But on the 15-minute time frame, I start something like this, right? So I look for my structural low, structural high, structural low, so same as the 4-hour low, and then we break structure over here. So just to speed the process up, I'm going to go structural high, structural low like this. And then from here, the way that I like to do things is I look for a sharp move up and then a sharp move down. So for me, my next structural point is actually going to be up here, right? So this is my dealing range, right? So my dealing range on the 15-minute time frame is from this low to this high. And so what I'm going to be doing is I'm going to be breaking down this massive short post FOMC. So if you're trading and you want to get clear setups, it's important for you to understand the best moves will come post FOMC, right? Recently, the FOMC price action over here, even from on a 5-minute, it does look very, very trashy, very choppy. It's very difficult to trade this. Now, in order for you to catch these trades, right, or catch a piece of this move, what you want to understand is 2 things: key levels and order flow. And that's what I'm going to be breaking down in this video. Now, if I go to my ES futures chart, I've got the same, this is the exact same chart, this exact same dealing range. So again, I've got my structural low, I've got my structural high, and it's important to understand these shorts came in premium, right? So this is the equilibrium. Of course, anything above that is the premium, right? So I just project my fib tool from the low to the high, and this is my premium. Now, what's interesting to understand here is we had this entire move to the downside, right? So this entire move to the downside occurred due to the fact that price was reacting off key levels, right? That's the only reason price actually moved down. So what we want to do is we want to focus on how do I find, these areas, and especially these levels and these levels, right? These are important levels. And so what I want traders to kind of understand is that, think of it this way. Imagine you're on a road, right? And there's multiple bus stops. Right, there's multiple bus stops. So the road is like the direction of the trade, right? So this is your road. Now, if you want to catch a bus, you want to know where those bus stops are for you to get on board, right? There's no point chasing the bus across the road. That's not what anyone does. You want to wait for the right bus stop, and then you want to basically go in the right direction. So it's a similar thing in the markets, where the analogy is you want to know where to enter from, and then you want to know what to do when you come into that level. So what I'm going to be breaking down is, why do I have these levels? So if you trade ES futures, these are the levels you need, right? So you're looking at 70.05, you're looking at 69.83, 84, and then you're looking at around 69, 60, 50, 55 to 65, roughly those areas. So how did I get this key level? So this key level actually came from the 13th of January. So this is the point I'm trying to make to traders. When I find my key levels, I look for a 15-minute fair value gap, right? So this here is a 15-minute fair value gap. So fair value gap on the 15-minute time frame. Now I choose the candle before the fair value gap. And so what you're going to find is throughout the weeks, we had order flow back reaction. So here sellers were in control, right? Vice versa here, sellers were in control, right? Now again, one more time, sellers were in control. Sellers were in control here as well, right? So we can see that. Now, of course, I'm not showing you the order flow, but what I am showing you is this was a level that gave me, so I took a trade on the 13th, and we're seeing the order flow, we're seeing price constantly gravitate towards this level, and we see passive sellers sitting in these regions, right? So that's my theory behind finding the level. So it's not any 15-minute fair value gap. It's a fair value gap that's backed up with the order flow. And I'm going to be breaking down what that means. So another quick note to make is when you have a good key level, so for example, this reaction, the best trades will often come at that same key level in days and weeks to come. So don't ignore your level. So once you have a good key level on the charts, don't ignore it, right? Stick to that level, right? Understand where that level was, because that level reacted from the 13th to the 16th, and then it reacted on the 27th, and then again on the 29th, right? So what's going on here is we had price reacting as demand, or buyers were in control, and then of course FOMC was trashy, and then Thursday we react as supply. So the lesson here is once you have a good key level, do not ignore that, right? Do not ignore what was going on previous days, right? This is I guess you could call it support and resistance, but at a higher level, right? So you're using order flow to back up your positions. So that's kind of how I find my key levels. The level I want to break down in this particular video is this ES level over here. So this is 69.83 to about 89.90 area. So I want to break down how I got this key level, what I did at this key level, and why this key level gave a decent short. So if we go to the 15-minute time frame, what we want to understand is where did this level actually come from? So this key level came from the 16th of January. So this area over here. Now, if we zoom into this particular area, what we can see is obviously lower prices, right? So we see this clear rejection of this particular area. Now, for me to take a trade, I only take a trade based on order flow. And so what makes my key levels valid is the order flow rejections, right? So here we have our key level over here, and I'm going to be breaking this down on the Discord. Now, if we break this down, this is a trade I actually took on that day. So we're going to be going over the rejection over here. Now, on a 1-minute chart, what we can see here is a lot of blue delta resting in this zone. So I've made previous videos about the delta, how I use footprint charts, how I use order flow. But specifically, this is our blue delta. These represent buy orders, right? Aggressive buy orders hitting the ask. The ask is greater than the bid. Now, the reason this holds as a key level, and I did take my executions from here around 69.82 for that day, what this confirms is that this particular area held as supply, right? This was a supply area because the aggressive sellers failed, right? Sorry, the buyers. All these aggressive buyers failed, right? And that's what created the short. Now, the reason this is important is because you need to burn into your brain that you have to remember these levels whenever you go on the charts. So here we had a level, 16th of January. Now, what's important to understand, this is what I do, right? So 16th of January, we had a supply zone. Now, this supply zone held as demand during FOMC, very choppy, and then it held as supply. So throughout the whole of the month, we had the 16th, and then of course we had the 27th, and then we had the FOMC chop, and then again we have a clear level of supply. And so the market will remember where these areas of supply are, right? This is a supply area, this is a supply area. And so this is what I want everyone to kind of burn in their brain. What's going on here is that this is an area of absorption, right? So this is what creates the level. Absorption creates the key level. Absorption creates the key level. And so this is what creates a key level. And the market remembers where these absorption points happen. So here and then here specifically, right? These are the main areas you want to focus on. So if we just now go and break down the actual trade. So a couple of tips about this. This was a huge sell-off. Now, in my opinion, you don't want to catch all of the move. You only want to catch some of the move, right? So just going to break this down again to make it clear to traders. We had a break over here, right? So this is the price action that effectively was worth trading, in my opinion, right? So market opened up very bearish, and now we had our break and retest over here. So we had this break and retest zone just like this. And so I want to break this down to traders. What was going on specifically over here and how I would look to enter. Now, when I see price breaking below my level, I just draw a line like this. So this is what I call my break line. And I tell myself I'm not allowed to go short unless price gets below this line, right? We have to break below this line with the body, and we have to understand what was going on effectively inside of this region, right? We want to know what was going on inside the key level. And so to understand that and to break that down, if I were to go short here as we break below this red line, I want to be sure that there's actually confirmation that price wants to go down, right? That we want to see these lower prices. So the way we do that, and I've made lots of videos on this, the way we do that is by looking at this chart here. So this is the footprint chart, right? Or this is the footprint charts that allow us to see who's in control between the buyers and the sellers. Now, when we look at this for this particular key level or this rejection zone, right? This is a 5-minute chart, right? And on the 5-minute chart, we can see the same key level, so 69.83 to about 89.90. So what we can see inside the zone, we see that blue delta, right? Just like what was going on over here. It's the same thing, right, as the 16th, right? It's the same kind of thing, right? So when you see lots of blue delta and we have a break below the zone, this here just means that buyers were aggressive. So think of the delta as what's going on in the now time frame. Who is aggressive in the now? It's actually the buyers, right? Because we see blue delta, and then we break below, and then we have this very interesting wick rejection over here, which I thought was very interesting. So that wick rejection is ultimately where the market started tanking. So what was going on over here, right? Let's break down a few of the numbers. So another question I had was, do you need to read all the numbers, right? So I don't sit here reading every single number. I'm not interested in any of the numbers. I'm interested in what the numbers do to the delta. So in other words, do we have a positive delta? Do we have a negative delta? The delta is what allows you to read the story. So if we break below this zone, we're looking at this kind of retest area over here. So this retest area is similar to what was going on here. So essentially this retest is, it's reading like this, right? This is how the retest reads itself. So when we see 341 for 506, when we see 0 for 75, when we see 57 for 203, this is the ask being a lot greater than the bid. And what that means essentially is that there are more aggressive buyers and sellers, but the market couldn't reward those buyers, right? Those buyers were not successful because they didn't have follow through. So think of it as key level, buyers and sellers, and then absorption, right? This is the absorption principle that I speak about in almost every single one of my videos, right? So if you're looking for this short move to the downside, this here is the characteristics of it, right? This rejection in close looks like this. Aggressive buyers with the blue delta, but no reward, right? That is what creates the downwards move, right? That's what creates the shorts, right? That is what creates the shorts. Now, the same thing happens here, right? Effectively, the same sort of thing happens over here. So we come into this next key level over here, right? Just to break down this key level again so that traders can appreciate, this key level here actually came from the 4th of November, I think it was, or even before that. So, no, sorry, 5th of December. So again, this was a 15-minute fair value gap, right? This was a 15-minute zone over here. And what we're seeing is we are seeing the market constantly giving us real evidence with the order flow of aggressive buyers failing, right? So we're seeing the aggressive buyers failing over here. Again, this is, you want to do this on the order flow, on the footprint chart. So you want to see a fair value gap and you're looking at the rejections. You're looking at the reactions, right? Who is aggressive? Is it the buyers? Is it the sellers? So we take this same theory and notice how I'm dragging the zone to the right, because what you'll find is a lot of the major moves happen at that level. The market remembers where trapped participants were. So that's exactly what happened here in this key level. So this particular key level over here, we had more rejections, right? We had multiple rejections. We had, I think, 2 rejections before we went short. So I didn't catch any of these live, unfortunately, today, but I was just watching from the sidelines. So again, what makes this key level valid, right? So if you're looking to go short here, right, just like up here, if you're looking to go short, what's going on here, what's going on here, right? That's what you need to understand. So again, I'm going to do a very, very detailed dive as to how you can trade this key level. Now, realistically, what's going on is you are interested in the retest, right? So this is the retest area over here, right? Because we have a break below and then we're retesting, and then we're breaking lower. So you want to focus on what's going on after the break below the zone, right? So that's where we start to use the footprint charts again. So the footprint charts become useful because you actually know what you're doing, simply put, right? So even here, we had the break and we're now looking at the retest area. So very specifically, if we dive in, we have, it's a red candle, right? A red candle, everyone knows what a red candle means. It just means a ton of aggressive, it just means that the price is moving down. But what's going on in the level? It's the opposite. We see a lot of aggressive buyers, right? So here there's a lot of aggressive buyers, but for me, it's here. 28 for 289, right? 28 for 229. So that was going on, that was happening here, right there. So if we gotta dive into the rejection again, right? This is that rejection kind of playing out over here. So what you can see, 28 for 289. And so that here shows you that the buyers here were truly unsuccessful. Because if these buyers were successful, 289, and even over here, we see, you know, a similar thing. We see 243 for 452. We see an overwhelmingly amount of aggressive buyers, but they were unable to break above this zone, right? We break below the zone. So how would I capitalize on an entry? Something like this, right? So you can either be a bit more aggressive and just go short here. I prefer to be a bit more conservative. I'll have my stops just above this area. And from here, I would just target the EQ, right? 1 to 1, 1 to 2, 1 to 3. No matter what your risk rewards are, it doesn't really matter. That's all that matters is that you can read price accurately, right? You want to understand what was going on. So rejection, and then we had our second set of rejections over here as well. Now, if we quickly break down the second set of rejections, it was the same sort of thing, right? So levels are found from order flow, not the other way around, right? Levels are found from order flow. So here we can see again a lot of blue delta without even reading the numbers. The order flow footprint charts give you an indication as to who is being aggressive at your levels. It's the most important concept. Now, once you've understood this, you can start to appreciate why the market melts the way it does. Okay, so that's sort of my post FOMC analysis going into Friday the 30th of January, right? So just a quick breakdown of what we've been through. Essentially, it's how I find levels, because I get this question a lot, right? So the way that I find my levels is, a quick summary is, we go through market structure, right? We understand these are highs, lows, highs, and then from there I want to be shorting in premium, right? I want to be a premium shorter. Now once I understand that, I then look for previous fair value gaps that have had proven areas of absorption that have given me good trades, and I just extend them to the right, right? And then I look to use those same levels again. So it's almost like a lazy strategy, but you'll be surprised at how effectively it works if you understand how to choose the right fair value gap, and then ultimately how to read order flow at that fair value gap.